What's going on, everybody? Michael Silva here. You're watching the Daily Stock Market Brief. I don't have my camera turned on because, well, I want to get this video out sooner, and when I take out video, it uploads faster. The date today is October 28th. What we're going to be doing today is we're going to be looking at the S&P 500, and we're going to be looking at some key indicators, a couple commodities, and then the US dollar. The overall question probably on everyone's mind is, can this selling continue? And if so, where can we find a potential bottom? We're going to be mapping out some key levels to kind of help determine what might be taking place next. Let's get into it. All right, welcome back. If it's your first time here, welcome to the show. I do these Monday through Friday. We use technical analysis to kind of get a good idea as to where the market might be going next. In today's video, like I said, we're going to be looking at the S&P 500. I'm going to start out on the monthly time frame. So what you see here is the monthly time frame, which means every candle represents 1 month of data. And you know, if you've been following along for a while, we talked about this outside trading month right here and just last month. And what an outside trading month is, really, we came above the previous month and we traded below it. And that right there is pretty bearish on this big move to the upside. And what we got going on here, the month isn't over, and we saw a little bit of a ramp up, and now we're getting pulled back into the 5 EMA. Now, what I want everyone to pay attention to is, first off, we are still an inside trading month right here, so it's not necessarily bearish at this particular point in time. It doesn't look all that healthy, and you have the long upper wick, which represents a lot of bears stepped up. Then you have this broadening wedge pattern, so it's kind of getting pushed lower. But we're sitting right here at the 5 EMA on, you know, what was a pretty rough couple of days of trading, these last 3 trading days. So if we start cracking below this 3,200, that is going to, you know, that will signal some warning signs, I would say. But I would say overall, from the 3,000 to 3,200, that zone would be a good risk zone to potentially pull back into and see some sort of a bounce from that specific point in time. The 20 period has held as support previously. We've seen that multiple times. We can see it kind of through this channel right here. So, you know, like I said, if we start breaking through 3,200, I would expect 3,100 to be the next trigger point. Keep in mind, the longer the price action stays above here, the higher these moving averages go. And as you can see, this is the Bollinger Bands. That's the shaded green area. And we got overextended. And when things get overextended, you get retracements. And we had an overextension from the 5 EMA, and that's a frequently tagged exponential moving average, and what we've seen here is a retag. So this could very well act as a level of support heading into the rest of the month. But you know, there's a lot of information being thrown at us right now with the presidential debates around stimulus, around COVID, all kinds of stuff. And we just had news today that France is going on a lockdown, and the market did not respond well to that news at the end of the day. Here's the weekly time frame. The weekly time frame, a couple of things that I want to point out. We cracked through the 20 period moving average, which is in the middle of the Bollinger Bands. That typically, like I said, acts as a level of support like it did right here. Boom, we bounced to the upside. So this looks pretty darn heavy for the most part. We broke down through this level of support. And, you know, like I said, we're still trading within the month. So if we start cracking below 3,200, you know, we come down lower. Now, this is why I use multiple time frames. You can see the lower Bollinger Band right here is between 3,000 and 3,200, is right around 3,100. So that's why I'm saying this zone right here can act as a good risk-on type of zone if we pull back, and then we might be able to catch a bounce from that specific area. But let's dive into the daily time frame here. Based off the thumbnail when I said twin gaps, see, the previous one I was talking about twin peaks. Now I'm going to talk about twin gaps. Down here over in mid-February before the market crash, we had this gap right here. Very similarly, today we had a gap right over here around the same, you know, just right around the same exact level coming down. Now, I find it interesting because it was a gap down through the 5 EMA, and today, you know, the previous trading day we were below the 5 EMA, the 50 period moving average. I keep saying 5 EMA, the 50 period moving average, but this really just shot us down lower through that 50 period moving average. So now we're really heading lower into that 3,200 level. Now, overall, I always like to look at context. And this, the reason why I'm bringing up context here is because the overall trend is still technically positive. And if you really zoom out, you can just see that the price is within this channel. So yeah, we had 3 crazy trading days, but keep in mind, we're still in a channel, and we're kind of moving into this oversold territory. So if we start reaching down here, it's likely that we get bounces from these levels. That's not to say we can't head lower, but we have the 200 period moving average on this time frame. We have this level of support, and it all confluences within the other time frames that 3,100 to 3,200, even as low as 3,000 when you look back here. So that's why I've been saying this right here, this zone could very well be a hot zone for people to start buying into, quote unquote, the dip. Let's zoom in just a little bit more here on the 2-hour time frame. And what we kind of paying attention to here is just, first off, I want to point out, now this is obviously shorter term, so this is where you can kind of hone in closer on entry points, exit points, and so forth. We're oversold on the 2-hour time frame. We're running into Thursday, which we have huge earnings coming out tomorrow. So being that we're oversold, that we had this gap down, and then we also seen the VIX. We reported on the VIX the other day how it got overextended and it was likely to see potentially to come fill this gap. But we also kind of held the possibility of this being a bull flag because of the fact, well, it's pulled and it flagged and then it kind of jammed us up at the very last moment here. Then we gapped up higher. Very similarly today, this is a pull. It was a gap. And then we had the long upper wicks overextended from the Bollinger Bands, and then we got jammed up towards the close. So we're getting a little frothy and overextended on the VIX, which we'll look at on the daily time frame. So keep in mind, with earnings and all this stuff going on, it could be very, very possible, being that we're overextended, to come back in to fill these gaps and potentially then move higher. Now, if that is the case, I would expect to see, what we could potentially see tomorrow is even, just the way that we closed, we might gap lower into this pink shaded box. This is the kind of the first zone of support, I would say, which is, you would meet the bottom right over here, or right between the 21st of September to the 28th. And we might very well get positive news around earnings, and then that might shoot us up to have a positive day. It's a possibility. The market's very weird. And now I'm not trying to predict anything because, every time people talk uncertainty, it's when I pretty much tune them out for the most part anyway. But if there's good evidence to support it, it does kind of help that narrative. And what we're seeing here is just levels of support. We're seeing overextended moves. It's possible that we get continuations to the downside, but it's also very possible that these supports hold up and we see some short-term to intermediate term bounces. Here's back on the daily time frame. I should have probably had these switched over, but really this is just a zoomed in portion of the daily channel that I was talking about. All the gaps have been filled. Remember, we were talking about gaps on the way up and we're like, holy moly, gap, 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 gap. Now what are we seeing? Well, we're seeing gap downs, filling in the previous month's gaps. So, potentially these gaps could get filled too as well on the way up. If we start coming down into this area and then we start seeing a bounce to potentially fill, and then potentially we head lower depending on what is going on in, with the presidential election or really anything going on. But from a technical standpoint, we still have support below us, even though it was a crazy, couple of days of trading here. This here is the BKX, the KBW Bank Index. I just wanted to point out that we've been watching this on the weekly time frame from here and there. Overall trend is bearish, right? We had the 200 period sloping down. The reason why I'm showing this banking index is, one, it's comprised of the 25 largest institutions in the U.S., or 24, I can't remember the exact number. And when you see the financial sector really struggle, that puts a lot of weight on the equities markets. So if you see this go down and continue to move down, it's going to stress out, the S&P 500, the NASDAQ 100. It's going to stress out everything. And what we've been seeing here, we came up to around 82.50, and now we're trading around 74.79. So just a large 4-day decrease, clearly. And, it got rejected by the 200 period moving average. The symmetrical triangle, we broke down through it once, and then we kind of just came back up and traded within it for a little while, and then we just got rejected back to the downside. So I'd say that we got to look at 70 as a level of support, and if we start breaking through that, we're going to see a lot more downwards pressure, not just in the bank index, but also in the various equity indexes as well. Let's look at just a couple indicators here. I'm going to first talk about the VIX. We've been talking about this inverse head and shoulders. We broke through the neckline. It's getting very, very frothy. 78.51 on the RSI. That's overextended. And when we get overextended moves, it can continue. But we typically see boom and then pullbacks, boom and then pullbacks, and boom, and then pullback. So you want to watch out for something like this to potentially take place. We have tech earnings, like I said, that can very well send us lower, maybe fill a gap, and then potentially push higher after that point. This being an inverse head and shoulders, we could just head a lot higher. We can go to 50 to 60. That would be, an ideal range of a breakout here. We have a little bit clearly we have resistance right here at 45. So if we start breaking above that, volatility can really pick up. If we start getting into this zone right here, that's going to send us down to that target area, probably most likely around that 3,000 to 3,200 zone that we just been previously mentioned. So like I said, very overextended here on the daily time frame. We have this gap beneath us. We have earnings coming out. Maybe we gap down tomorrow in the S&P 500, and then we pull back from that point. But anything can happen overnight. So we just got to be very patient, very careful with everything that is taking place. Here is the NASDAQ 100 bullish percent index, and this helps to. I use this to find overextended moves as well. This is based off of point and figure charts. So really what it's saying right here at 53 is 53% of the stocks in the NASDAQ 100 are on buy signals based on the point and figure charts. They look like a gigantic tic-tac-toe board. And when we were up here, we haven't shown this for a while, but when we were up here at 85, that was an overextended move in my opinion, just by looking at the history of the chart. And we matched in that 85 with the RSI being overextended, and we're like, okay, it looks like we can probably pull back from here. And we did. We came up to 12,000 here on the NASDAQ 100, and we started pulling back. Now we're at 11,142. So clearly the indicator helps us find these overextended moves. So what am I looking for now? Well, the RSI is moving into oversold area where it could be overextended, which would tell me that, the move can still push lower, but we're coming into the overextended range. And when we get into these overextended ranges, that's when we could typically see bounces. So yeah, it can head lower, but we're kind of getting into that range. This was a very aggressive move to the downside. When we get aggressive moves, we can see those sharp increases as well. And you can just look back in the history here. We got oversold here, boom, to the upside. You can see the NASDAQ 100, the NDX, boom, to the upside right here too as well. Then we got boom, right up to the upside, as you can see. So I like to look at the overextensions, and I also like to look at bullish and negative divergences on the chart. Let's take a look at commodities. Commodities right now got the hammer, probably because the dollar was shooting up, which we'll go over that chart in a moment. We're still above the trend line. The trend line held as support. So this is good. I was actually kind of excited to see this flush to the downside. I've been saying that I want to pick up more down at about 1800 to 1815. There's many ways you can do that. A lot of people ask me, what do you mean by limit orders? I got that question yesterday. You can do limit orders in the futures market, or you can just buy the physical metal, or you can buy GLD, or you can buy SLV. If I'm talking limit orders for GLD and the price action comes down to this for this specific chart, what you could do is just, when the price of gold comes down here, you can look at where the price of GLD is. The charts look very similar, but then you can enter in at that specific time. That's not a recommendation. That's kind of just what I'm doing. Another thing that I'm looking at is the physical asset. I like buying from APMEX. You can buy from JM Bullion. You can buy from your local coin shop. You can buy physical assets, physical metal, physical silver, just about anywhere, and there's a lot of reputable places. Another one is Sprott Money. So, just do your research, kind of see what best works for you. I pay a little bit more than most probably people on APMEX, but I just like their customer service, their reputability, and I also like that they keep track on this cool dashboard on the website. And I'm not being endorsed by them by any means. It's just I just like purchasing from them. That's pretty much it. So if we start getting down into this range, this is where I'll be picking up some more gold. Could we head lower? Yeah, we could head lower, but I'm overall pretty bullish here, and I would love to pick up some more down in that range. Silver, we've been mapping out. We didn't show this yesterday, but wasn't much to report yesterday. Now we're having this bigger move to the downside. We mapped out this ascending triangle, but we saw that it was, kind of coming from a bearish context. We're below the 50 period, and now a down day of, almost 5%. That's a pretty strong move to the downwards direction. You see the MACD crossing over. RSI, still has room to fall. I'd say, it'd be easy to come down a touchdown in 20 to 22 right here. If we start getting into the 200 period moving average, similar to gold, this could be a very nice spot to pick up some SLV or some silver as well. Let's look at the US dollar. US dollar chart didn't update, so I just drew in a green box as to what it would look like because I just looked at the prices. So I still have the head and shoulders pattern right here. Head and shoulders pattern, it's very early for this and we're starting to see it move. It could very well break. You can also, like I said, this could still be technically a cup and handles, pushing the boundaries of a cup and handles because of how low it went. And I will say though, today's price action could very well still feed to the narrative that, we got this cup here and then we have a handle move right there. So it's all possible, but really if I just remove the head and shoulders, if I remove the cup and handle, this is a channel, it's basing out. If we get above 95, we start moving higher. If we go below 92, we start going lower. If we go above 95, that's going to put pressure on the equities market. It's going to put pressure on gold, put pressure on silver and various other commodities or assets. If we start heading lower, you can definitely see gold and silver really start running. All right, everybody, that's all I have for you on today's daily stock market brief. Overall conclusion, you need to be careful in these obviously in these times. But what's good about these pullbacks is they always offer some type of opportunity. Now that doesn't mean that an opportunity means just buy right here and then go long, but it does offer very, very good opportunities when we see these pullbacks. You want to see this stuff take place because it's healthy to see these things take place. When you just see rampant run-ups, and crazy market caps, it's one, it's dangerous, two, it's not realistic, and three, it usually ends like we're seeing it end right now with these gigantic volatility spikes and all these gaps and just this crazy movement. So, be careful out there. Be very careful trading and investing, and just look at these major levels of support and resistance to really kind of plan out your trades ahead of time. And when you do that, you're not going to be so worried about what's taking place in the markets on that specific day because you already have a plan set up in place, right? So that's all I got really for you today. I will see you guys on the next episode.